Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Matthew, thanks for taking some time to join me on the show.
Thanks, Owen.
Today we're going to talk about macro. We're going to talk about lessons learned from companies. And I think this is going to be quite up and down the vertical. And by that, I mean, we're going to look from the top down and the bottom up, hopefully, to try and illustrate your investment philosophy and how you think about the world of investing. But maybe to kick things off, I've been listening to quite a fair bit of, some of the commentary you've had in the past. And I've spoken to the team before at Wilson Asset Management, and they've talked to me like, you got to ask him about macro and get his views on things. So they've kind of thrown you in the deep end there, but I know you'd like to talk about this stuff anyway. So maybe just to break the ice is, how would you describe the macroeconomic environment right now?
Yeah, well, the great thing about the macro environment, it changes very quickly, and what a perfect example this week, with 100 basis points coming off the short end of the rate market. So the environment's changed dramatically from, 2 weeks ago. We have Powell talking about, higher for longer. That's all changed with the SVB collapse. So dramatically changing. Again, forward rates coming out of the market. There's talk about, lending standards being tightened across the US. So that environment is not great for economic earnings or activity. So the environment has changed dramatically, and it's gone from more rate hikes this year to actually rate cuts this year. So that's all happened within a week. So huge change in environment.
That is, like you said, a dramatic shift, right? It's like almost sounds like the peak of Everest. You've kind of just realized we're at the top. But there was one actual follow-up question that I had. I was just briefly mentioning it off air, is how much macroeconomic variables and factors and thinking goes into your process, but not necessarily like it's just like that's the question, but how has that changed through time? And in particular, maybe if you could map that to your career, what you were doing in earlier parts of your career, but like when you joined Wilson and now, and how the macro lens has affected your process?
Yeah, that's an interesting question, because it's a multifaceted question too, because macro becomes more important around inflection points. So macro is very, critical to thinking around those big inflection points between, rate hike cycles and rate cutting cycles. Mid-cycle, not so important, because everyone just goes about their business. You won't watch, at the moment, everyone's watching CPI prints. Mid-cycle, no one will be watching a CPI print, and there's no market reaction, because we're mid-cycle. The policy tools are essentially neutral, not that important. For me personally, I used to manage large cap money before and multi-asset money before coming to Wilson Asset Management. And then when I first came here, started managing small to mid cap money. And the macro is really not that important for a lot of these companies, because they are growing from a very small base and can grow quite aggressively into a market, versus the larger companies trade more in line with GDP, plus or minus a few percent if they're lucky. So the more mature companies have higher sensitivity to macro variables, whereas the small to mid cap companies, ultimately they will get caught up in macro eventually, but in between and around inflection points, they can move less, because they can actually still grow because they're coming from a small base. So it's, again, macro is important for the small to mid cap to large cap. The difference there is large cap much more important, and then macro is more important around those big inflection points. Mid cycle, everyone sort of forgets about it again.
It's interesting. Are you referring to, when you say like the sensitivity, are you talking about like the fundamental performance of a business? Because some people might say, well, small caps tend to be very volatile in the share prices. So are you referring to like business fundamentals there?
Yeah, more the fundamentals of the company, the environment they operate in. Like, let's say Australia GDP gets downgraded by 20, 30 basis points. That will have a direct impact on a lot of the large companies because everyone uses these economic impacts or sensitivities in their models, whereas the small caps will probably just would look straight through it. So it's more around the fundamentals, nothing to do real with the share prices as such.
That's interesting because then if you think like that, I guess then you might be inclined, if you are in that small or mid cap space, you might be inclined to think, well, that's actually an opportunity for my investment process to take advantage of that kind of, I guess, dislocation between fundamentals and price. How about then? So if we just maybe zoom in on like the WAM leaders and the money that you're managing now, how much of your time spent thinking about the portfolio is macro? Like I asked you before, like what do you get up and check in the morning? Maybe that's a way to illustrate how you think, like the first most important thing when you're thinking about the portfolio today. How do you think like macro informs that portfolio specifically? And maybe you could talk about some of the things you do each day to get a pulse check.
Yeah, it's very good question as well because there's so much information. Our game of investing money is about gathering information and trying to get the best information you can. So what I'll be watching outside of market hours is around, obviously you got the European Open coming through, you get some signals, you got economic data coming through, watching FX markets, rates markets, just to see where money is flowing and also risk appetite as well, because you get, as we talked off air, like bond markets, processed data, there's less emotion, whereas equities, they're pricing hope and dreams and blue sky, and it's either all on or all off. There's a little bit more emotion in the equity market, so you get a more pure read, I guess, of how actually the economic conditions are going and also where money is flowing. So the things I'll be watching are rates, short end rates, the belly, long end rates, volatility as well. So some of the volatility measures in equities, like the VIX and the MOVE indexes, which give you an idea of how much risk is, or the appetite, I guess, of risk taking in those markets, or how much people are willing to pay for that. Positioning as well, like you get a lot of money these days like CTAs, which are momentum strategies, and we try and check how they are positioned because we never really want to be on these momentum trades when they turn. So we look at all that, and then we look at equity. So I'll look at all those things before I look at the equity market, what happened overnight, and then what I'll do is every day check the sector performance of the US markets and the European markets to try and get a read of where money is flowing, what's performing in that environment, but then marrying it up to how rates performed. And sometimes they don't marry up, and then you think, well, that's maybe the equity market has got it wrong in the short term. So we're always trying to triangulate data and to make sure it makes sense. And the reason why we do that is to try and eliminate as much risk as we can when we make investments. So we're always trying to get the odds on our favor, and we find if we look at all these different data points, it can quite often help you.
How, just for context, how much of your day, on an average day, it's like a typical day, if you have one of those, would you say is spent thinking about those things, and how much of it is spent on the company by company, like at that level?
Yeah, it's during the day, it's quite often all the decisions have been made, or all the framework about looking at macro is done outside of market hours. So quite often I'll be like the Asian trading hours is not that crucial for the macro environment. It can quite often move the other way. Like in Asia, oil will be up, and then Europe and US open, and then oil will be down. So Asia is not the greatest read for the macro. So often just watch at night. So I'll stay up quite often, very late to watch the US data releases, which can, when the daylight savings move apart, it becomes a bit of a nightmare because it can be like 12:30, 1:30 releases, but that's winding back now, thankfully, and you can get around 11:30, 12:30 releases. So quite often watch the releases come out, and then you're trying to gauge the reaction to how the market interprets those releases. to see if the good news is good news, good news is bad news, and all that. Just trying to work out how the market's positioned. So all that thinking around macro framework is done outside of market hours. During market hours, it's engaging with the Australian market. We're seeing companies, talking with companies, we're talking with contacts. So all the macro decisions are predominantly made outside of market hours. Unless there's an RBA decision or we've got some big economic data in Australia which could shape the interest rate view. So CPI, employment numbers and all that they are important, but predominantly all the macro work is done outside of Australian trading hours.
I might ask one follow-up on this actually, if I can, and think about this from like the bottom-up approach, like how it actually is expressed in the portfolio. In that, how many like new ideas would you have in the portfolio? Say, if we took maybe however you want to frame, maybe it's like every 6 months, every year, like every quarter. I don't know, like. But what I'm kind of getting at is like a full position for you. Like, how many of those big decisions do you make? Because one part of me is thinking, okay, he's thinking a lot about like the macro lens each and every day. How much of that is noise? How much of that is signal? And how does that translate into the portfolio, if you get what I mean? So I'm trying to gauge that kind of like push through from signal to execution in the portfolio.
Yeah, like we're highly active, so we're making adjustments daily. We don't change the positions. We don't. I shouldn't say we don't, but we quite often wouldn't trade you know, from in at 100 basis points to out of the portfolio. There'll be adjustments. So 100 basis points, we might go down to 50 or 150. And we make a lot of those decisions daily. So we have the portfolio is very active. But you're right, there's a lot of noise. So the way we're trying to do it is we have three pillars where we're looking at the macro, then the fundamental analysis, which is the company, and then positioning analysis, which is around where is flow happening? Is it, where are the crowded trades? Is the market long or short different commodities in particular? So ideally, we try and get all those three things lining up. But quite often in reality, that will never happen. So throughout the day, there'll be new information coming out from Japan or China. China is very important. If there is a clear signal from that, we will trade that. We'll adjust the portfolio weight. So very active. There's constant adjustments when we get proper signals, but a lot of the signals, as you suggested, can be noise. The skill is dissecting which is noise and which is actually market moving, and have some duration on that trend versus just a flash in the pan.
I saw a economic update you did with Tom Petrovsky from Comsec, and this was going back to August 2022, I think it was. And at the time, you were talking about the macro environment and how things had shaped since COVID. And one of the things you said, he asked you, like, what are some of the things that keep you up at night? And I think you were talking about like credit spreads and maybe like a collapse, like some sort of event in that regard. And that was the thing that you were very mindful of. And like you said, just this week, SVB, Silicon Valley Bank, I don't know how you characterize that, but basically traded to the point of collapse, and the government's come in and rescued it effectively. How do you characterize that as a signal? Because that seems like it's like front page of the news, seems pretty big. Have you made any decisions on the back of that?
Yeah, like it's still up for debate about, is this going to have a longer impact or not? How did we react? We reduced some of our banking exposure because, again, quite often on equities, they reduce risk first, then ask questions later often. So we went into it was almost preservation mode. We actually reduced risk out of the portfolio because whatever happens here, none of it's positive. Like you've had two banks going under now in the US. You've got this, essentially it's like a 1-year repo where people can trade, the banks can put in whatever collateral they want and they get liquidity. So you've got about a year to deal with it. They'll probably extend it if things deteriorate anyway. But it hasn't really fixed the issue. And what we know for certain is lending standards will tighten in the US. And that's not great for economic activity. The flip side is, as interest rates fall, in theory, PEs could get better. So the financial conditions are improving, the economic conditions are deteriorating. So there's a fine balance here, but at the moment we're in everything into meltdown territory. So um, the correlation between rates and markets going up has broken finally, which is very welcome to see. But the impacts we don't quite know yet, but they are negative. It's just what degree they will impact global markets. The impact has been dramatic already as far as rates markets goes, and equities obviously are feeling it pretty hard as well at the moment. But the one thing probably to say is the Australian banks are nothing like these US regional banks. So not to say they will go up from here, but concerns around safety are unfounded.
That's it's a good point you bring up there too. Like, we're only a week into this saga, so I should mention that we're recording this on the 14th of March, and so the story is yet to play out. One of the things I noticed when I was looking at the WAM leaders portfolio in particular is that performance since COVID has actually been very strong, and like significantly, outperforming in this like, I guess, couple of years. And I was hoping you could just characterize that for us. Is why has it performed? Is it that macro piece that you said, like, it's at those critical junctures where macro plays a huge role and therefore adds the performance? Or just how do you think about that?
Yeah, it's again, like, you quite often think back and what led to the outperformance. But I guess since the GFC, we've been living in this environment of very low interest rates, and it's been very supportive for a certain sector of the market, predominantly the techie end and the long duration end of the market. I mean, why did we do well during COVID? I guess there's a key event in March of 2020. And there was two camps, economic depression, the world's going to end. And then the other camp was around looking at the fiscal policies which were being implemented and also the monetary policies. And we went with that camp because probably the biggest lesson is the stock market is not the economy. And quite often people are like, why is the stock market going up when the economy is like in ruins? It's like, well, you look at the policy settings and the fiscal transfer from the public sector to private sector, and there was enough cushion there where asset prices could go up and would go up. So we invested very heavily in that period when, at its darkest, we just bought everything we could that was high quality. We knew the business model was sound. We knew they would trade through it. They had balance sheets which were, robust. And we took up all the capital raisings in the banks, and anything we could get our hands on in a capital raise we took. And that set us up for a really good period. And then I guess there was another critical point where interest rates were moving up and the market was in the inflation is transitory camp. Rates will never move up. There's too much debt in the world. Rates can't go above 2% on the 10-year rates. We took the opposing view, and we were like, the forward market was already there. So it wasn't, we were watching that move up and up and up. And we're like, the equity market was just ignoring it at a point. And then all of a sudden, on these inflection points, it all happens in a day or two. And if you're not positioned correctly, you miss out on a large amount of performance. So when the equity market finally thought about interest rates rising, I think we made it like 250 or 300 basis points of outperformance in a few days. So again, that set us up for that inflection point of rising rates. So yeah, inflection points are great if you can get them right. But generally you get a pretty good read on what's happening. And the other key point why we performed was around taking a position on China when they were going to stimulate as well. Intra the COVID lockdown period, there was a point where the property market, everyone thought the property market was going to implode, and we managed to get that as well. So quite often those inflection points are good. And I think the way we invest, we try to do it through high quality companies. We don't go up the risk curve too. So that backdrop was very supportive of the way we invest, because we weren't on zero interest rate policy settings for too long. Finally, we came out of that, and we could capitalize on that too, because when you have zero interest rates, a lot of the rubbish companies go up as well, because there's just no barrier for these long duration assets to not go up, people to speculate, and you get a lot of speculation in all sorts of different asset classes too. So we welcome that change. And again, the period we're going through now, very much welcome too, because it's taking out some of those excesses and bad businesses, which I'm hoping are allowed to happen and we don't get full bailouts again. But again, the propensity for pain is very low at the moment. So we're seeing that already.
So actually, that's an interesting point if you're willing to dig into that. So we're obviously seeing dispersion between pretty poor quality companies, which will probably fail in this environment where there's higher rates and so on and so forth. We're already seeing that in, like, I was chatting to a venture capitalist out of the US earlier this week who was saying something, along the lines of what they're reporting and what's actually happening on the ground is not the same thing. What we're seeing this is the day of SVB's, 60% odd share price collapse. So keep that in mind. But he was saying what we're seeing on the ground is not, what they're reporting. It's like, everything's not that great, but we'll be fine. So no, it's actually radically different to this time 6 months ago. And I guess the question is, like, the dispersion that we're going to see with some companies really faltering. Why, in your mind, is it important that we do see that washout as opposed to being saved?
Yeah, I guess it gets down to, productivity and, efficient use of capital. You need to have these cleansing periods. And I don't think we've had a real cleansing period since the GFC. We've had glimpses, 2012, 2016 and 2018, and then I guess in COVID, but they've been very short-lived, and there hasn't been. I think there's been too many companies kept alive for these periods and it's just not productive use of capital, which is, in economic theory, it's all links back to standard of living and the like. It's all linked. You should allocate capital to the most efficient use. So it's really just that big picture view of a cleansing is not a bad thing if poor users of capital fail and the good, more productive users of capital survive. I mean, that's how things should work in a normal functioning economy.
And I think I don't know if you'd agree with this, but the venture capital end, like, if you're taking the full spectrum of markets from government bonds right through to credit markets, then through to equities, and then through to the more speculative and then unlisted assets and venture. Like, venture's right at one end, maybe alongside some cryptocurrencies and things like that, where it's almost seems like that is going to be most afflicted by this type of thing. Do you think that's a fair characterization?
Yeah, I mean, on that end, on the risk spectrum, it requires functioning capital markets because they all need capital. These are not companies which are generating cash. So the moment liquidity gets tight or credit spreads get tight, lending standards, these things fail because they burn money. They actually need capital. They need functioning capital markets to stay alive. So that end of the market just gets decimated because they can't survive. They can't fund themselves.
Well, yeah, and I mean, if you add in a bank that seems to be lending long duration, long duration into a tightening cycle, then you probably end up with a few things like we've seen recently. Okay, so this is quite interesting. But I mean, if we bring it back to the portfolio and how you're thinking now, so we step away from that kind of more speculative end, not completely speculative, but more speculative end. I had a question which was along the lines of, if inflation or if rates are persistent, how do you position the portfolio for that? But maybe I won't give you that hypothetical framing. Maybe I'll just ask you, how are you positioning the portfolio now and how are you expressing that view?
Right. So you really got to dissect, short-term, medium-term, long-term. Short-term, we've been reducing risk, but that was something we've been doing for about 3 to 6 months too. Taking a very defensive tilt in the portfolio, investing in high quality, because we were looking at all the leading economic indicators. They were all pretty terrible, to be honest. So we were like, we weren't that confident on the economic environment, and we thought interest rates would be cut from a falling economic environment and a falling inflation environment. So we were going very defensive, but we didn't want to go into the speculative end of the falling rate part of the market where you go the high growth and tech, because we thought the economic environment was so weak. We'd rather play the more, the very safe cash flow companies, which are infrastructure companies, the old bond proxies, I guess you could call them, that benefit from lower rates, but their cash flows are fairly sound. So that was the way we were positioned. And what I guess the short term view now is I'm trying to work out if short term rates have overshot from this shock. We've dropped, as 100 bips in the US. I was just looking before the Aussie 1 year rate. I think we're about 40 bips under the cash rate at the moment. So I'm just trying to work out if maybe the bond market has been bid too much in the short term. So I'm always thinking about contrarian trade. So I'm thinking, maybe some of these insurers look all right, which have been sold off on the back of falling rates in Australia more aggressively than the banks, surprisingly. So always looking for these contrarian trades. So that's short term, but the overarching portfolio now is high quality companies that will benefit from lower rates eventually. Still backing China as well. So the measure I'll look at, the China total social financing, which is sort of like a broad credit measure in China, has beaten the last 2 months in January and February by a large margin. That's normally a good leading indicator of activity in China. So we've got expressing that through BHP and Rio, so the bulks, more so than industrial metals because of the faltering economy at the moment. Like industrial metals more linked to global activity, whereas iron ore is very, very much China focused. So position that way. Consumer staples position quite heavily in those as well. So the Woolworths and Coles of the world. Trying to make sure the portfolio is as resilient as possible, but always keeping our eye open about when to add in risks. So you don't want to stay defensive for too long because all of a sudden you could get this, Fed speak coming up over the next week or two where they say, hey, we're pausing, we could cut it. You just never know. So once that happens, the leadership of the market changes very quickly. So quite often you will have to run a little bit of a barbell approach where you have a little smaller holdings in some of these companies which will benefit from that narrative shift. So, but yeah, overall, the portfolio I classify as high quality, defensive, with that China bet still embedded in the portfolio. Massively underweight Australian banks, more so on their NIM outlook, but fortunately, it's been beneficial because of the stuff going on off in the US as well. But that's probably the best way to sum up the portfolio at the moment.
How would you, just interesting, like I know a lot of our listeners and viewers would be interested in the bank stocks. You said the NIM outlook there is kind of leading that trade. What would make you change your mind?
Yeah, so what happened was the Australian banks were meant to have positive net interest margin performance basically up to the last RBA hike. And that was what the whole market thought. And that was going to be, back in February, maybe that was like, middle of the year. So you could have been like August before the net interest margin started declining. That was brought all the way forward to, almost the end of last year through competition. So what would get me excited now? It's hard to actually find a reason to get excited about the Australian banks because generally you want to be buying them in a rising interest rate cycle, not a falling interest rate cycle, because not only will the competition squash NIMs, but falling rates will squash NIMs as well. So it's hard to actually paint a scenario where you could go, let's go all in on banks at the moment because we're going to potentially go into an easing cycle. So I can't even paint a picture at the moment to go overweight Australian banks.
How far down? Another thing you mentioned before was, you might have that barbell approach. How far down the market cap spectrum do you go to look for those ideas?
Yeah, the one thing, like we get most of our performance through the top 50 companies. We actually don't really go down too far because we find our approach needs liquidity, and quite often in these smaller companies, you can't. Like we may see data move, but then we can't actually action it. So, there's really not much outside the top 50 We do have some companies between the 50 and 100, but it's a very small percentage. So when we talk about barbell approach, it'd be more through the just thinking like, like let's just call, for example, a Zero, a WiseTech, an REA, a Seek, more those companies, not the 150 to 200 type stocks, because they're just too illiquid in the Australian market.
Yeah, and those are still pretty big companies that you mentioned. They're in the billions of dollars. So, but when you're managing more than $1 billion or something, larger than that, you've got to be really mindful of the liquidity constraints, right? Okay, if I switch gears now away from this kind of macro portfolio positioning bent, one of the questions I was curious to ask you is, who has influenced the way you invest today? Like if I say to you, well, which person, whether it's through a book, maybe it's someone maybe it's like a family member, maybe it's a colleague, who has influenced you the most in your career and the way you think about investing today, and what impact have they had on you?
Yeah, it's again a very good question. I mean, probably the one that comes to mind, top of mind, is Stanley Druckenmiller. I just love everything he talks about. Like the way he views the world can be like, I mean, he even jokes himself about being a little bit simplistic on the way he views the world, but I mean, his track record speaks for itself. He's just quite amazing. And I guess why him? I mean, it's back to the the infamous Bank of England story. When he was working with Soros and Scott Bessent, just having the courage or conviction to actually trade these ideas in large amounts. I really admire that, because there's so many smart people around there, but they just don't have the courage to act on it. So for me, Stanley Druckenmiller, just the way he thinks, the way he says the thing that resonated with me was he said his best macro leading indicator is talking with companies. I mean, that approach to me, I resonate with, versus some of the more the quant style. I don't really resonate with, because they're just algorithms with correlations and all that. Whereas discretionary global macro, those guys I love, because you got markets, you got politics, and they take a holistic view and put on large trades and really back their conviction.
Okay, I've got kind of I guess another question around that is, so when you get these type of views around markets, you mentioned before that the equity market can be quite noisy because it gets quite emotional. So how do you think about the valuation of individual companies, and in particular, how do you do like, say, like a full discounted cash flow analysis? Are you looking for something like more multiples based, or how do you think about that? Because I'm thinking, in trying to put myself in your shoes, as I want to express a view, like say NIM compression on banks, and I want to make sure that I'm not, selling deeply undervalued stocks, that because I'm selling deeply undervalued, it's going to lessen the impact of my view, if that makes sense. Like it's going to run counter to my overall view, my top-down view.
Yeah, I mean, the best way I find anyway is looking at multiples, and looking at the historical multiples, peer multiples, because really, like we live in a relative world. Capital is always trying to find a home. So let's say, for example, like an example is probably a good way to walk through it. Like Dexus at the moment, the office REIT is trading at like a 35% discount to its net tangible assets, and you just look at that and go, well, that to me doesn't make sense at the moment, especially if bond rates are going to fall. So it's always looking at relative valuations and, putting it back to, net tangible assets, or historical PEs, or, peer comp PEs, or, and looking outside of Australia as well, like looking at global peers as well. And it's always just trying to, like, as I said, we live in a relative world. So you're trying to work out, is the outlook for this company getting better or worse at any point in time, and is it reflected in its valuation? So it's more the incremental. Doing a DCF, like personally, I find is a waste of time, because it's full of assumptions that change, potentially daily. And the more assumptions you make, the more errors you'll make too. So it's more the way we look at it is more directional. Are conditions going to get better or worse for this company, and is it reflected in the price or not?
What is you may not have this off the top of your head, but what is what's a typical holding period for a position?
Yeah, like it's actually quite long. So around 60% of the portfolio has been held for 3 years.
Right.
But when people see our turnover figures, they think, we're just trading in and out, but we're actually like pulling levers constantly, like daily, trying to push weights up or down based off new information. So we're very much data driven, trying to take into account new information, then trying to reflect it instantly. So we're always trying to have the portfolio reflect the current environment every single day. So we're always like, in theory, we should be able to make money in any market. We're not like a style bent, like a value or a growth. We're trying to make money every day, and data to input that in and then adjust the portfolio every time we see new information which could change a view.
I've got another question, which is kind of like it's like an inverting with a tweak, which is if you look around. So you said Stanley Druckenmiller before. If you look around at other investors that maybe you read or that you read about in the media or something, I'm curious to know which investors do you admire, so that you admire the way that they invest, but you would never do that, if that makes sense. So I'm looking for this whole idea of being like humble in the way you invest and not necessarily trying to emulate everyone, just trying to stay in your lane. So I'm curious, are there investors that you look at and you think, I really admire what they do, but I could never do that?
Oh, 100%. I mean, all the time. There's, people are investing tech or growth. I can't do that. But I guess the one for me is Jamie Simons from Renaissance Technologies. Very highly successful, what an amazing track record, but very mathematical driven, very quant driven, having computer algorithms running all these correlations. Like I wouldn't even know where to start with that stuff. So I admire him so much, the track record, unbelievable. But could I do it? 100% no. He's obviously, PhD in maths and, started from a bedroom, just built up this amazing business. I mean, just incredible.
Yeah, it's one of those things where you just need to know which lane you're in or which corner of the market's yours and stay in that part and just admire someone like that. Yeah, I totally, when I came across him, started reading about him, watching interviews, I just thought to myself, well, I'm happy not to be a quant investor because that's not the opposition that I want across the ring from me. I've got two more questions for you, Matthew. One is, so we've kind of touched on this, which is this idea of thinking about risk or risk versus return, at least. I'm curious, what things do you look to measure risk? And specifically, what I'm trying to get here is a lot of the academic theory. How much of that do you use, and how much of it would you disagree with in practice, I guess?
Yeah, I without being disrespectful to academia, I'd use zero of the academic risk measures because it's all built on what I think is a flawed assumption of normal distribution, which we know works during times where it actually doesn't matter if it works or not. But when it fails is when you need it to work and it doesn't work. So it's actually a flawed system, but it's, what do you do? I mean, it's probably the best of what we've got. I mean, you got to make assumptions around distributions, but use none of that. I look more at market-based risk. So we touched on that previously around what is the market paying for risk at the moment, like with the VIX measure of equities and the MOVE index of bonds. And that's, I'm really just trying to work out what risk is embedded in the market, how are people positioned. So for me, that's risk. And then on the portfolio level, I guess the risk I'd sort of point to is, again, it's a bit of a technical term, but beta of the portfolio. So how will the portfolio we manage move with the current market? And beta is not stable as well. So again, it's flawed, but you can sort of see, if I'm running a beta of 0.98, it means my portfolio won't move as much as the market. So if I've got a real defensive feel at the moment, I should be running a beta lower than the market beta, just intuitively. But again, it's more of a feel you have over time. Like when your portfolio is running a bit hot versus a bit cold, and trying to balance it. So unfortunately, there's nothing in academia that will help you. Obviously, it helps with hedging and the like, but again, hedges start to fail when the moments you need them most. So
Mm.
yeah, unfortunately, there's not a great risk measure out there to help you with equities.
I feel like if you're taking a strong view on banks, your beta would be, well, it's not necessarily different, but it may have to be compensated in other ways in the portfolio.
Yeah, no, that's 100% right. Like the portfolio is like an evolving piece of all these different pieces of the puzzle, and you have to be cognizant if you're like underweight banks. Okay, that's a big part of the index. So where are my overweights and underweights, and how will the portfolio perform? Well, let's just say banks start rallying, and at the moment we've got a 10% underweight on banks. Like we don't invest like versus the index, but just for
Mm.
comparison purposes. Yeah, I'll be left way behind if the banks run. So you got to have a high conviction bet, and then you've got to balance it with other parts of the portfolio too. So running resources, they generally have quite a high beta. So
Mm.
yeah, it's all a balancing act, because you never like the thing I learned with the greatest investors, they always progressively or scale in bets as well. You don't want to go all in all at once, because quite often you get it wrong and then you have to retreat. So scaling that's why I think the model we run works quite well, because you can scale in and out quite quickly based on changing in data. So yeah, it's nothing perfect is in investing with betas and the like, but
Mm.
that's sort of how we run it.
I should know the answer to this, but I'm assuming the answer is no, that you do not use derivatives in the portfolio.
No, we don't use derivatives. No.
If you could, would you, for the hedging and risk management?
Potentially. Yeah, like in periods like the last few months, maybe would have run, like a small protection, like volatility. You might be running
Mm.
a vol position to, it'd be a slight negative cost of carry running it in the background, but it's almost like an insurance premium where
Yeah.
you'd be running it, maybe 1% of the portfolio. So you're giving up 1% of the portfolio return for protection. So I mean, it would have worked really well, but that's definitely something I'd look at if I had the ability to run derivatives. But yeah, I mean, that's
Mm.
probably the one that stands out most, is just downside protection.
It's interesting because I find that cost of carry and the cost of protection throughout the cycle can be quite harmful. Like, can be very harmful for a manager's returns. But at moments of opportunity, maybe strategically, they can be used for that hedging. Unfortunately, obviously, then you have the vol factor, which increases the price of the protection. But I find that maybe those moments are when they add a lot of value.
Yeah, 100%. Like you could sort of like just thinking out aloud, like timing it. You're never going to be buying vol in a interest rate cutting cycle. Like once it gets underway, you never buy vol or go long like the first part of a hiking cycle. But around these inflection points, you could really that makes sense versus in just like a blind every year I'm going to carry 1%. I mean, that just to me doesn't make sense. You've got to be strategic about it, just like investing. Otherwise, you're actually not making a call. You
Yeah.
just I'm just going to burn 1% of the fund every year just in case. I mean, that just doesn't sit right with me.
Yeah, and we've probably lost a few people when we just started talking about that, so I'm conscious of that, but maybe that's a conversation you and I can have another time. I've got one final question for you, which is more philosophical in nature, and this is just your own personal view, which is, what's one thing that you've learned about finance, investing, or even business, that few people would agree with you on?
Oh, that's an extremely tough question. I mean, it's not quite consensus, but like I think people forget it. Like the stock market isn't the economy.
Yeah.
I mean, it's such a valuable lesson when you seen it. time and time again, but it's so you get caught up emotionally with everything looks so bad, and things are falling apart, the like job losses and the like, and it's hard to separate yourself from that emotion. But the stock market is definitely not the economy. There's linkages, but then the stock market is forward looking. So quite often in the darkest times is when people get the most depressed, but they're actually the best opportunities. So I guess it's not quite, I mean, it's pretty well known that that's the case, but I think people forget about it a lot of the time.
Matthew, just as we're in closing, I know a lot of people that have made it this far through the conversation will be extremely interested to keep tabs on what you do and how you think and how you're positioning the portfolio. Is the best place to go the monthly and quarterly letters that are available on the Wilson Asset Management website? Or are there things that you do? Like, do you do a lot of webinars and things like that?
Yeah, we're starting to do a few more webinars these days. But if you go through and sign up to our weekly email, we obviously send them out weekly with some of the insights. But yeah, the quarterlies, we try to send out quarterlies. We've got the monthly NTAs, which have a little bit of a snapshot. But we're going to start doing webinars more often now as well, just trying to, because obviously the market is moving a lot. We just want to keep people up to speed with what's happening and how we're seeing things. So just look out for some more webinars coming from us at Wilson Asset Management.
Yeah, great. I'll put a link in the show notes for anyone that's interested in the things that we've spoken about today and seeing what's like in the portfolios and those types of things. And a special shout out before we close out to the Australian Shareholders Association who put this together for us. Big badge of honor for me representing the Australian Shareholders Association here on the Australian Investors Podcast. So Matthew, I do really appreciate you taking some time out. You've probably got a busy day. It's probably company time now, and then tonight it will be macro time yet again. So I really appreciate you taking some time to join me on the show today.
No, thanks. I enjoyed the conversation. It's been great.